We are live now, Vivek.
Okay,
Great. I'll just quickly make you the host so that you can share your screen.
I think I can share. Okay.
Yeah, you'll be able to share your screen now.
Mm, mm.
And welcome everybody. Thanks a lot for joining us today in the webinar. It is the last webinar for the year, and we're happy to have all of you on a Thursday evening. I can see a couple of people asking questions and some viewers also have joined in already. So let's start, Vivek. Maybe you can share your screen and then.
Yeah, just a moment.
Sure, sure.
Okay, my screen is shared now.
Um, yeah, now I can see it.
Yeah.
Perfect,
Okay.
perfect. Okay, so the agenda is pretty much similar. We will go over the details, the changes that have happened in the last month. Then we'll talk about all the questions and answers that have already, certain questions have come previously in the form, and we'll also be taking questions from the live chat today in YouTube. Uh, Quickly going over ST and Gulaq, a lot of you already know about us, but for the new people who've joined us in the last month, ST is a pioneer in systematic investing in India. It was started in 2008 when SEBI permitted algorithmic trading in India. And over the last 16 years, it's developing investment and broking products using computer science and analytics. We have our own PMS service, which is the portfolio management service for HNIs. And we have overall 1,500 crores in AUM. Coming to Gulaq, it is actually the retail investment advisory arm of ST, which was started in 2020 when we thought, why not offer our advice to retail audience as well? You know, people like you and me who may not have 50 lakhs to invest at one go, but who have lesser than that and who want to uh, create wealth. Coming to the team, of course, you see only 3 people on screen, but there is a huge team behind the scenes, and they are helping in a lot of different activities, including marketing, product development, strategy, etc. Vivek, if you can move to the next slide, please. Yeah, the one after this. Yeah, Vivek, the next slide after this. I can see the team. Yeah, disclaimers. Okay. So just to quickly take you through all the disclaimers, you can feel free to pause the screen, go through this. But as a SEBI registered investment advisor, it is important for us to make our clients aware of the risks that are associated with markets and with any investment product in general. So we have highlighted some of the risks here. We have highlighted our registration numbers, our company details. So please feel free to go through this, rewind the webinar and go through this at pleasure. Moving to the next slide, we'll talk about the different changes that have happened in this month. You see that we have shifted our allocation more towards large cap. Similarly, if you go to the next slide, in terms of, I think the next one talks about the sectors. Vivek, I can't see the next slide if you've changed it. Yeah, this slide talks about the different sectors. So if you see in sectors also, there has been quite some shift. Consumer staples still continues to be the topmost sector in our portfolio, but we have reduced some part of it and moved it to healthcare, industrials, and financials. Similarly, we have halved our allocation towards IT and energy sector. Now, if you move to the next slide, Vivek, I think there is some lag because I think you're moving, but it's not visible to me yet. All right. Yeah, so this is interesting because we have actually moved some bit of our allocation from momentum to quality. Again, momentum continues to be one of the top 3. In fact, there are only 3 factors that we are now focusing on. It's momentum, leverage, and quality in the month of December. A little bit about Gulaq portfolios. This is for people who are new and people who are still confused as to, which one, which specific portfolio of ours to invest in. So just to let you know, you should not invest in multiple portfolios of Gulaqs. You should only focus on one out of the four because all of these portfolios cater to different risk profiles. So Gear 6, which is 100% equity, is for aggressive investors, while Gear 3 is for conservative investors who would also want a higher percentage of their allocation in debt, which is a low risk asset. So take the risk survey, which is present on gulaq.com, and then ascertain which specific portfolio is the best for you based on the asset allocation that is suitable as per your risk profile. And if you have any questions around this, you can always call our customer support number. Our support team will be very happy to help you. But please, there have been instances in the recent past where the same client has invested in multiple of these gear portfolios. That won't make sense because the equity component of each of the portfolio is exactly the same. What is different is the allocation towards equity and debt. Okay, moving on to the next slide. I think now a lot of people asked us about the returns. So over here in different slides, we are showing you the returns of each of our portfolios compared to the respective benchmark. So Gear 6 is 100% equity. So our benchmark is Nifty Multicap. And you'll be able to compare the returns. Of course, the alpha has not been positive, but the overall returns, now we are recovering. The market had fallen, and of course, because Gear 6 has a higher sharp, our fall was also higher. But now we are recovering while the markets are also recovering. So Gear 5, then if we go to the next slide, Vivek, you can see Gear 4 and Gear 3, all of them. And you guys can feel free to again rewind, look at the returns, which are also in fact present on st.smallcase.com. And if you have any questions on this, please feel free to message on the chat box right now. We can have a conversation or even reach out to us on the support team. Yeah, Vivek, next slide, please. That's Gear 3. Yeah, the next one. This is a full snapshot of all the different gears together. Now the last one, Vivek, on the returns. Okay, so this chart you would have seen earlier as well. Over here on the right side, you see different calendar years. The blue bar is Gulaq and the orange bar is Nifty Multicap, which is the benchmark. And you can see how Gulaq in each calendar year has performed relative to the benchmark. So from 2020 to 23, all the charts you will see Gulaq is quite high as compared to the benchmark. Currently in 24, it's almost the same. So the performance this year has been like that. And on the left, you will see how 100 rupees invested in May 2020 when Gulaq was launched in Gear 6 has been so far if it was put in Gulaq Gear 6 or in the Nifty Multicap, which is the benchmark. So 100 would have been 300 in Nifty Multicap and 674 in the Gulaq Gear 6 portfolio. All right, so that's about it in the beginning. Now we can dive into Ask Me Anything, into the question and answer section. Vivek, can you please take them through the questions we've already received? And in between, I'll pause you to take questions from the chat as well.
Sure, Eesha, thank you. So let's start right away. Okay, one of the questions is, over the last 1 month, 6 months, the portfolio has underperformed the equity multi-cap index. And over 1 year time frame, it's only break even. How do you see Gulaq's performance over the next 6 months to 1 year? Will it generate positive alpha relative to Nifty multi-cap index? Yeah. So one sec, I'll quickly. I think there was some issue. I've actually updated these slides. One sec, I think I've opened the previous version. Give me a minute.
Vivek, you need any help?
Yeah. No, one sec. I'm just opening the newer version.
Sure, sure.
By mistake, I actually opened the previous version. I made some more changes to it. So just give me a moment.
Sure.
Yeah, I got it. Sharing my screen. Yeah, you can see my screen.
Yeah, Vivek, if you can just make it in presentation mode.
Yeah. Looks good now?
Yes, perfect.
Okay. So this is as per the historical returns. What is the alpha to be expected over multiple time frames? So if you see over a 1 month period, the worst case alpha as per the historical backtest, and this we have done, taken almost 12 years of data and then came out with these results. So the average alpha that we expect in a month's time is about 1.8%. The worst case alpha has been -9%. So we have actually underperformed in one of these months over last 144 months. In the backtesting results, the worst case has been -9%, and the best case alpha over a month period has been 16%. So I think our expectation should be around these lines. So we can underperform the index over a month, but the average is this. Now, if you see over last 6 months, or let's pick up last 1 year. So last 1 year, what we have done, achieved in last 1 year is barely break-even performance as compared to the benchmark index. Whereas the average alpha as per the backtest is about 24%, but the worst case is also -14%. So we are somewhere between the average. Obviously, we are below average, but above worst case. So somewhere in this range. And this is to be expected. I think, Eesha, we shared one of the slides here,
Mhm.
which was showing yearly returns, right?
Yeah, that's the last one, Vivek, I think. The last slide just before the AMA.
Okay. Yeah. Yeah, this is the one. So if you see, we went live in May 2020, and over last 4 years, what we have produced is a fairly significant alpha. First year, this alpha was about 20%. Second year, it was about 30%. In 22 also, it was close to 20% alpha. And last year, again, it was more than 30%. So I think any active strategy, it goes with active strategies performance, that any active strategy, it's really very hard to beat the benchmark very, very consistently. So there'll be definitely times where an active strategy would would underperform. And this year, as you can clearly see, we haven't done as well as last 4 years. So the investors who have actually came in last 6 months or so would be disappointed looking at, they must have invested looking at historical returns, but last few months returns hasn't been that great. So I can totally understand that disappointment uh, for the investors who came in last 6 months or so. But there are many, many investors who have been with us for the past few years, and they are pretty happy because over that time frame we have delivered very good returns. But I think this is something that we have always highlighted, that with active returns, or even with investments in equity markets, there's always a risk in the that you would underperform the benchmark, or even the benchmark would give negative returns. So these are definitely risks that we have made our investors aware, that equity returns, you should always look at the performance of equity funds, whether active or passive, over slightly longer duration. And as I'm showing in this, uh, the expectations, I set my expectations on the basis of this, and yeah, that's what it is. So I think it's pretty normal after a period of 4 years of huge outperformance. We have had one average year. It happens with almost all equity funds. Yeah. Okay. Over the past 3 months, monthly rebalancing has resulted in continuous losses. Why did you buy 36 stocks and sell them next month? I'm doing SIP of 25,000. However, small case is only purchasing 12 stocks. Okay. First, let me answer the first question. Okay, so about 4 5 months back, we were on this Gulaq old portfolio, which consisted of about 12 to 15 stocks. Now, this is the back test. As per the back test, uh, the 10-year CAGR in this specific portfolio was 39%, the information ratio was 1.57, and the turnover was 72. Now, after that, we included the sector block. We have had this sector block in our PMS for more than 2 years now, and that was really performing very well. We saw improved performance, and that's why we decided to include the sector block in our Gulaq portfolio. In that, the difference actually was hardly uh, visible in terms of CAGR. It remained roughly similar. But if you see, our turnover actually reduced, our information ratio, which is a measure of how consistently you are doing as compared to the benchmark, that also improved. So we have been working on this for a while now, and we included that specific sector block, because of which our stocks became 36. Now, when we release this, after that, we continuously keep working on improving these models. Now, within a very short period of time, we were actually able to improve this sector block also, so much that the best sector block performance we were actually getting in a portfolio of about 15 stocks. So now if you compare this 36 stock portfolio to this 15 stock, you can see slight improvement in the returns. But what we try to optimize is on the information ratio, which increased slightly. The turnover has increased slightly, but as compared to the older portfolio, it is still way better, right? And this is all compared to the BSE 500. So this is what has happened over the past few months. These changes have taken place, and I can totally understand there is some uncertainty in investors' mind, because this has never happened in the past that we have changed these models so frequently. But now I think for now, we are definitely done with these changes. And these changes are all for the better. Obviously, you should not correlate this changes with the performance, because over past 3 to 6 months, our performance hasn't been great. So many people are questioning our move to this newer model, which has the sector block. But I think it has just got to do with the markets. We have checked our performance even in the Gulaq old portfolio. We have seen this underperformance in the recent underperformance that we are seeing. It's happening with almost all our portfolios. So this is nothing to do with which specific portfolio or the portfolio change. It's to do with the methodology that over the past 4 years we have done phenomenally well, and this is a time frame where we are not performing as well. Yeah. But overall, these changes are for the better, and for now, we are definitely done with these changes, and we are going to stick with. Obviously, we keep working on these improvements, but I don't see any major improvements. These major improvements typically happen when we launch initially our portfolios, but over time, there's only incremental improvement, which even if we change it from the back end, investors are not really going to feel significant change in their portfolios.
Right. And I would just like to add that this was, a long due change. Uh,
Yeah.
People knew, we had informed everyone some 7 8 months back that we have been working on a lower churn portfolio. So this was that big change that was long overdue, and we finally did it. But like Vivek showed, from 36, we also decided to move to 15, because when we launched the 36 size portfolio, we figured that a lot of investors who are starting with lesser amounts were not benefiting as much because of the increased transaction charges. So
Yeah.
we took a call, and within 2 months, we tweaked the strategy a little further to keep the churn low and to also reduce the number of stocks. And now we continue to be as is. In fact, Rohit Vivek is saying that one thing is you guys are continuously changing the strategy. And
Yeah.
secondly, the stocks are changed so quickly that there is barely a chance for stocks to recover. But I think now we have paused the changing of the strategy, that we don't feel the need to do that, right?
Yeah, see, these changes would definitely not occur, uh, but in any case, see, we have brought down the turnover also from above 70% to now it's close to 50%. But anyway, see, this is many people consider this to be a bug in the system, that we have very high churn, but this is to do with all the quant strategies. And there is a significant upside to having this high churn. That upside is in terms of producing more consistent returns, more predictable returns, as
Hmm.
with almost all quant strategies, and also better risk management. And
Right.
because of this similar high churn, we have been able to achieve the past performance also, where I just showed that over the past 4 years, we were very continuously able to deliver about 20% alpha annualized on an annual basis, right?
Hmm. Hmm.
We have been using the same strategy to same high churn strategy to deliver those returns. It's just a matter of time before our strategies also start performing, right?
And Vivek, just one more question from Sahil Goyal before we move to the questions on slides. He's saying, are we considering keeping few stocks for long term, more than a year, as a value investment?
Now that's a interesting question actually. Could be considered. See, this is definitely in our PMS. Because the significant size of PMS, which starts with 50 lakhs, we have more leeway, right? And in that, we have a small allocation to a longer term strategy, which is actually performing well and which holds these stocks for much longer, right? So do have capability to do this. However, I'm not really sure because this is a constrained portfolio. We have launched this portfolio to serve even smallest of investors who can start with 25,000, but our recommended size is obviously about 2 to 3 lakhs. But people can actually start with much lower sum of capital. I'm not really sure whether this is a possibility of having these longer term stocks in this small portfolio, but this is something I think we can definitely check and let you know how exactly the back testing results come out to be. But we can definitely check this.
Got it. Sure, Vivek. We can come back to YouTube questions later. We can continue with the slides.
Great. So the next question from Harish is, I'm doing a SIP of 25,000. However, small case is only purchasing 12 stocks instead of all 15. Even though the minimum investment is 24, ideally it should buy all stocks. Can you clarify? So Harish, there could be, I think there could be two reasons why this is happening. One, there could be some issue, some bug in the system. So you can write to us and keeping small case team in loop, we can figure this out. However, there's another thing that can happen, which is not necessarily an error. So what could happen is if your portfolio is, let's say, slightly on the larger side, say about 5 lakhs, 10 lakhs, as compared to the SIP that you are doing. Now, over the month, now, one thing is if you are doing it on the same day of rebalance, ideally this should not happen, right? But what could also happen is, let's say, over the month, let's say you are rebalancing on 15th November or putting in new money on 15th. So from 1st to 15th, there would be definitely some changes in the allocation that we had suggested because some of the stocks would have given profit, some of the stocks would have given loss. So the allocation would change. Now, what could also happen is, let's say if a stock has given very high returns, then anyways, the allocation to that stock would be very high as compared to the model. So it might not be tempted to give to buy into that specific stock. So that is one of the things that could be happening. But what I would say is, Harish, you please write to our support team and we can investigate this issue and let you know whether this is actually uh, an issue or this is along the expected lines. Okay. Okay, let's move on to the next question. What is the beta of the Gulaq portfolio in relation to Nifty multicap? Is the beta constant or does it change with every rebalance? How is the beta considered over the past few months? Gulaq portfolio has experienced greater drawdowns compared to equity. Could you explain why? So I think the second part, Bhargav, I have already explained. I think based on the historical results, this is to be expected that over a short duration, we can definitely underperform, and that's what is happening currently. Now, first part of the question, I think you need to give us some time. Beta, we do look at beta, but how constantly does it change? All of that. Obviously, this would be a high beta strategy, right? But how much is it and how frequently is it changing? What we are going to do is we are going to put all of this data in a fact sheet and release that fact sheet in the near future, which will give you a much detailed look at our strategy, including what the beta is. So please do look out for that specific fact sheet. We'll be rolling it out pretty soon. Okay. Parag is asking, I've been an investor in Gulaq Gear 6 for the past year, but I'm struggling to understand the strategy. There's excessive churn. Stocks sold in rebalance are often bought again in SIP. Despite understanding the risk before investing, there seems to be no holding period for stocks. Frankly, an FD during the same period would have given better returns. Recently, we moved. Okay. So, Parag, obviously, you're not happy with the returns. Now, Parag, you compared the returns and you are mentioning that FD during the same period would have given better returns. I'm not really sure about that because over the past 1 year or so, I think what we have delivered is close to 24%. Now, depending on your overall size of the portfolio, dependent on when you are rebalancing and also your brokerage, how much you are paying in your brokerage, these returns would be lower. Now, I'm not really sure what exactly is happening in your portfolio, but if you're saying that they are not even beating FD returns, you'd need to please get in touch with our support team so that we are able to figure out what is the issue. But having said that, what I've already explained is this is the slide I'll keep coming back to, that there is a possibility in the short run with equities, they can definitely deliver lower than FD returns. So we have seen years and even the COVID fall, where markets fell almost 50%. So I don't think it's the right comparison. What you should look at is your overall portfolio and if your portfolio is having the right asset allocation, right? Because equities will definitely give you more risk, more drawdowns as compared to FD. But over long run, there is no doubt that they'll also give you much, much better returns, which you really can't expect in an FD, right? So over short term, definitely FD can give you better returns. I think, Parag, what I would like you to do is have a look at your asset allocation because what is needed, I think what is definitely needed is we are able to hold on to our portfolio for long term. So if the volatility in stocks is something that is troubling you, then definitely you need to reduce your allocation to equities and shift to debt, right? And in the short run, we have underperformed, but over long run, we have definitely given very, very good returns. And this is a feature of equity investing in general, that over short term, there's a lot of noise in the market, but over long run, the kind of returns that you can expect from equity, I don't think any other asset class can really give you these kind of returns.
Vivek, Shivam Raj is he's stating that sir हम लोग जितने जोर से गिरे थे उतनी तेजी से रिकवर नहीं कर रहे हैं. He's talking about gear 6.
Yeah, so that's what I'm saying. See, in short term, this is not happening, and I can totally understand your disappointment with the portfolio. So, because we are not performing well, all these issues that there's a lot of churn or the stocks, we are not giving enough time uh, to recover to these stocks which are in loss. All of these issues are coming up. Whereas we have been using pretty much the same strategy for 3, 4 years, right? So earlier also, in fact, earlier the churn, if you can see here, the churn was even higher, right? So these issues were happening earlier also, but because the returns, the strategy was performing during that time, we were not really looking at all of these issues. Now, if strategy is not performing, obviously, we'll try to figure out what is happening and we'll try to figure out the reasons. But there are no specific reasons as such. I am not really concerned. In fact, uh, I was just looking today uh, in my small case because somebody has mentioned, can we share our returns? Now, when I looked at my returns, I started this, obviously started long back, but to this broker, I shifted about 1.5 years back, specifically in July last year. Since July last year, the point-to-point returns have been closer to 65%, and my returns have been 45%. They have been lower because obviously there are some slippages, but major reason is because there is a significant amount of capital I have invested in the past few months, and I have seen close to zero returns only on that, right? But the overall strategy in last 1.5 years has given me 45% XIRR,
Hmm.
which is pretty solid,
Hmm.
right? So I continue to keep adding. I do systematic investing. I keep continuously adding to my portfolio, not only in Gulaq but overall to equity portfolio. And that is what I would expect anyone to do. Be systematic about this investment. Uh,
Even for me, I can mention, since someone had asked,
yeah,
for me, in the last 2 years of investment horizon, my total returns have been 41%, and I have not been very proper in rebalancing, at least initially. So this
okay.
is my total returns, and the XIRR is 32.05% right now. Again, I have also invested a lot lately.
Hmm.
So the last 7, 8 months, I put in a lot more money. And of course, even I didn't earn a lot in the last 5, 6 months. But
Yeah.
over time, what my overall portfolio, if people know about XIRR, which is the time weighted rate of return, that has been 32% for me so far, over the last 2 years.
So as I was telling, the people who have invested with us, who have been with us for more than a year, most of them are pretty happy. And I can totally imagine because they have tasted this return earlier, they have much more patience
Hmm.
now.
That's why we're waiting and, waiting for it to even Umesh Vedya has messaged just now in the chat that he invested from November 22 and got 35%, but no
Yeah.
return from September 2024 lump sum,
Yeah.
which is evident. Even
Yeah.
in the returns we shared, we did have a bad month in October.
Yeah.
So, when the markets fell by around 4.5, we fell by double the amount, a
Yeah.
lot more than double. So
I think
if
Eesha, one thing I remember overall also, I think it was in January this year that
hmm,
I mentioned that over the past few years, we have delivered huge alpha. So the markets also have given very good returns. And on top of that, we have been able to deliver very good alpha. And what I mentioned, I clearly remember was that the biggest risk currently that I see
hmm,
is in having unreasonable expectations both from equity markets and from us.
hmm.
Right, that is the biggest risk I quoted, and I think that's how it has been over the past 6 to 9 months. That equity markets have given about maybe 20%. We have also given something similar. So yeah, so I think this is part and parcel of equity investing. This is mm, uh, nothing out of ordinary that is happening. It's pretty normal market behavior.
And Vic, someone else, Mohanty is asking, portfolio PE and PB is very high. Some of the stocks are expensive with poor quarterly. Are these factors weighed in adequately in the Gulaq algo?
Yes, these factors, not only these factors, but we have more than 40 fundamental factors that we score each stock on. So, along with these factors, there are a lot of technical factors also that we score each and every stock on, and then construct our portfolio.
And like Vivek said, so 130 plus factors where fundamentals are also an important part. So Supriyo says, I'm unable to invest. It was lucrative initially, following you since inception, I think. But
Okay.
that time I didn't have enough money. Later, when I had it, I somehow wasn't convinced that, hence I'm not pursuing.
Okay. Yeah. See, over that's what I keep repeating. In equity, what is most important is your discipline. Because if you keep looking at either equity market levels, whether they are overvalued or undervalued, or even these with these active funds. whether that is underperforming or overperforming over short duration. You should not look at this over short duration, and 1 year is fairly short,
Right.
right? So you should look at have longer term view. The longer term view you have, uh, the better edge you will get, and you will be able to make better decisions also.
Mhm. Yeah, that's correct. Okay, Shivam also is asking that the monthly rebalancing in starting month, but starting में किसी company के results भी नहीं आते. So I think he's asking why is it that we are doing it at the beginning of every month?
Yeah, see, results keep coming throughout the month. Whenever results come out throughout the month. Uh, so how do you decide then? On the basis of what exactly, which is the best date? And we have done this analysis. We have done a lot of back testing, uh, and then figured that this is the best strategy to follow.
Hmm.
Right? So results keep on coming out throughout the month, and with these quant strategies, uh, maximum weightage is to the technical factors, right? So for Gulaq, it will be something around say 60 to 70% of the weightage would be to technical factors, whereas whereas about 30 to 40% would be to fundamental factors, right? So anyways, results and fundamentals do make an impact, but the bigger alpha is generated when we rebalance on a monthly basis on the basis of technicals.
Mhm. And yeah, like you've said, that we do, we have checked the returns, the results, and if we do a more than monthly frequency, like a fortnightly or a weekly,
Yeah,
it's a lot of noise and it does not make sense. The slippages, the
exactly.
churn, etc., everything will increase. But
Yeah,
if we do not rebalance even once a month and we keep holding on, we may lose out on opportunity. So the optimum frequency is monthly. And again, people ask, that why the beginning of the month? Why not need basis? But who decides when is the need to rebalance? There has to be, if we are deciding, then it's not really quantitative. Then it's all manager driven. Then there is a personal bias involved. Ki, okay, let me do it now because the results have come. Let me do it now because elections are here. But if we have a set frequency, then the algo will tell based on results or happening still date. This is how the market is looking and this is how you should go about it. So that's why there is a set frequency to get some systematic investing into place. Okay, so a
yeah.
lot of more questions are coming, Vivek. Maybe we can continue the slides and then
Okay,
we
and
can
then
go
we
back
can
to
do.
YouTube.
Definitely. Yeah. So Yashasvi is asking, in the recent podcast, a small case manager mentioned that quant-based momentum strategies often show high returns, but investors rarely achieve them due to slippages. Frequent rebalancing and stock hitting upper circuit during rebalance can reduce the returns by around 18%. Could you share any insights on long-term differences between strategy returns and actual returns due to slippages? So I think we have already shared, Yashasvi, I shared my returns. What I've achieved is closer to 45% XIRR since July last year. Eesha has also shared. And a lot of investments I have made in last few months which has not given me any returns at all, right? So definitely there are some slippages, but I think first of all, this small case manager, I'm sure he's not a quant-based manager, and that's why he is biased. And I am also biased towards quant because we are using quant. What he's mentioning is not entirely incorrect, right? So if a strategy is based purely on momentum, right, that will be a very that will actually have very high churn also, and also it will have very high slippages, right? And this specific strategy, I don't know which specific strategy he is talking about, but this can happen. So if you are using a regular run-of-the-mill momentum strategy, which anyone can make, which anyone can actually predict also, that which stocks would be included, then it's very easy for large investors to game that system, right? And slippages would be very high. But what I've also heard from many investors is that although you are a quant strategy, uh, your portfolio is quite different than the other quant funds, right? So that's he was mentioning about the positive of our portfolio, that the way we are constructing our portfolio is quite unique. And that's why there is little overlap between our uh, quant fund and others. So this is what I have heard. I don't know how exactly how much is the overlap, but this is I have heard from the investors also. So this can happen, obviously, the slippages if you are invested in a purely momentum strategy, and that momentum strategy is again run of the mill and does not offer any differentiation. So this can definitely happen. But I have not seen too much of slippages. Obviously, slippages would happen. Nobody is going to get the exact returns that are displayed on small case. There'll be some slippages. It depends on when you rebalance. Plus, the biggest is it depends on the broker you are using. So if you are paying higher brokerage services, then definitely there can be significant slippages. I don't think there's definitely no way in Gulaq you are going to have 18% annualized slippages. It could be, excuse me, in my view, of the order of somewhere between say 2% to 6%, depending on your brokerage. Yeah. Okay. This is again one of the data points that we have shared earlier. This is as per the back test. What are the chances of Gulaq Gear 6 beating the benchmark? Now, if you see any random 1 month period, these chances are closer to 65%, which means over an year, roughly 6 to 7 months, maybe 6, 7, 8 months, we will be outperforming, but there'll be 3, 4, 5 months where we'll underperform also. But if you can see that as your holding period increases, your chances of beating the benchmark also increases. So if this is a 1 year period, then this chance increases to almost 90%. There's still 10% chance that over 1 year we can underperform. And over 2 year period, it's closer to 100, but it's still not 100. So there'll still be chance, although that chance is very small. So this is what I was talking about. And this will be, I think, similar for any active strategy, no matter how good a fund is. This will be the case that the longer you hold that specific fund, the higher chances you will have of that fund beating the benchmark. Obviously, not everyone would be beating the benchmark, but at least for those good ones, uh, your chances would increase if you take a longer term view. Okay. Uh, this is Parikshit asking, following Eesha ma'am's recommendation to allocate 40% to small case, 60% to mutual funds. I'm seeking guidance on mutual fund allocation for investors aged 25 to 30 with high risk tolerance. What would be an ideal allocation across large, mid, and small cap? Should we focus on single large cap allocation or diversify across all strategies? Now, this is highly investor dependent, but since you have given us some details that you're young, you have high risk tolerance, what I would say is have allocation to all of these three. If you want to reduce your risk, maybe have much higher allocation or purely allocated to large cap. But if you can take some risk, have some allocation to mid cap and small cap, and this can be achieved either through a multi cap fund or a flexi cap fund. That's a good way to go about it. Actually, we have also written an blog on multi cap versus flexi cap. So if you want to know the differences, I would encourage you to go to gulaq.com and check out that blog that we wrote maybe about a month back. That should give you a good perspective of what are the differences between a multi-cap strategy and a flexi-cap one. Yeah. Should we focus on a single large cap allocation or diversify? Yeah, I would say diversify across all three strategies. That is a much better approach. Now, one of the question is also why not focus, if I can take risk, why not focus only on mid and small cap, which could give me higher returns as compared to large cap? Again, the risk would be very high. We have seen in times of crisis, the overall markets or the large cap easily can fall 50%. That's what we have seen in COVID fall also and in 2008. whereas mid cap and small cap could even fall 60 to 70 or even 80% also. So that's the kind of risk that we are talking about, this which happens maybe once a decade, right? Another thing is, I was just looking at the small cap versus large cap. Now, the perception is that small cap and large caps give, small caps and mid caps give much higher returns than large cap. I think that might be true, but there is a higher risk also involved. A much better strategy is you let the fund manager decide through a multi-cap strategy or a flexi-cap strategy how exactly to allocate, because in one of these periods, we are talking a lot about small caps here. Now, if you look at this small cap strategy, if you consider period from say Jan 15 to Jan 20, almost 6 year period, it was flat, right? Only after that it has given. So 5 to 6 years, if you are purely focused on, and I'm sure mid caps also would have been similar, but even from here, this peak to this, from somebody who started in say about August SEP of or somewhere around 18, Jan 2018 to about October 23, again 5 to 6 year period, flat returns, right? And on the same period, if you consider about here, this is Jan 18 from 10,000 to more than 15,000. So roughly 50 to 60% returns, whereas in small cap, zero returns over this 5 to 6 year period. So it's very hard to actually call. If you're experienced enough, then maybe you can take this call where exactly you want to allocate more, whether it's large cap, small cap, or mid cap. But I would say uh, that only if you are experienced and you understand these issues, then you can take allocation to individually market cap based funds. But otherwise, a safer strategy is you follow a multi cap or a flexi cap approach. Yeah, I think we covered all the questions
Yeah, Vivek. So I'll take, there are a lot many
from
more in the
YouTube.
chat box on YouTube. So I'll start taking them. Um, Manoraki is saying, sir, do you have any data of how many investors have stayed with you since inception? I will just complete 1 year this month and have rebalanced on the same day. From comments, I see many lack patience. Okay. I think he's saying that
See,
we
the ones
should.
who are happy generally don't attend these webinars.
Yeah, yeah,
But
that's true because
see,
some do.
the numbers keep varying actually. How because if you consider the first 4 years where our performance and equity markets were doing very well, this number of people who were staying with us was very high. Whereas if you consider right now, this number has come down. It's still on the higher side, but it has come down as compared to the last year.
But have you looked at the number, Vivek, of people who were with us initially and whether they are still with us? I have not looked at that data.
No, even I haven't looked at that data, and I don't know whether that is the right metric. Maybe the percentage of people we should talk, but not the absolute.
Yeah, the
Because
percentage
what
of
is
people who are renewing versus
yeah,
unsubscribed.
renewing? Yeah.
Yeah, yeah, yeah.
So I think that percentage again, that percentage we keep looking at that percentage is maybe somewhere between say 70% to 80 or even 90%. Few of these months it was closer to 90% also. And when our performance is not good, it could be 65 to 70% also. So it usually varies in that range, right? And this is to be expected. See, that's what happens most of the times. There's this very famous story that I keep coming back to, that of Peter Lynch, the famous fund manager,
Yeah.
who during 1990s, I think, he managed Magellan Fund. During his 13-year time, uh, S&P gave about 13% returns, and his fund gave about 29% returns,
Mm.
right? And he was also, although this was not a quant strategy, but his churn was more than the double of the average churn. People used to actually complain a lot during the times he was underperforming. So it's not that all 13 years he outperformed, but there was a study done after he retired that how much people made in his fund, and very few people actually made good money, even though the fund delivered very good returns. And typically, what was happening was that few years the fund would perform very well. Lot of investors would come in at that time, then there'll be some period of underperformance when they'll go out, right? So they are typically, most of the investors come in at top, the funds underperform, they go out, and then the fund starts performing, right? So you could be invested in a very good fund and still not make money. So that is definitely a possibility. That's what happens. And this is what we are seeing currently also, that that's what the turnover in our in the number of subscribers, this keeps happening.
Right, right. Okay. Supriyo says, what happened to the mutual fund or mutual fund based portfolio? Vivek sir mentioned someday before about mutual fund license, if I remember correctly.
So both of these things are in the works. Now, mutual fund as a license, that is slightly medium term plan, because even getting that license could take up to a year from SEBI, right? And after that, actually setting up the AMC, launching mutual funds, that is maybe 1 to 2 year kind of a plan. But we are also, what we are doing is, a lot of investors have asked us about advising them on creating these mutual fund portfolios also. So that is also something that we are working. We'll see when we can launch. I really can't comment on it, but that is definitely something that we are working internally to do. So both of these things we are working on. So in the near future, you are going to see.
Perfect. Sachin says, how do you decide which factor to give what weightage? Is it human judgment or algo driven? Also, could you please take a moment to elaborate leverage factor?
So these factors, 130 factors, nothing is left on human judgment. We have systematized, made rules around all the things that we want to do, so that we take this human bias. That's what we wanted to do, right? It depends on market conditions. And historically, we have tried to figure out the patterns, that what are the kind of factors that one work in one kind of regime versus the other factors that will work better in other kind of regimes. So based on that pattern recognition, we have figured out, we select only a few factors and then give weights to those factors. So it depends on the market regime that we are currently in, and could change slightly from month to month. Leverage as a factor, it's kind of a quality factor. So if you consider the leverage, which is maybe debt, so debt to equity ratio or debt to capitalization ratio, how effectively a company is using its debt, factors like these are considered in the leverage ratio.
Okay. So Prakash says, sir, I'm a new investor. Backtested data is from which date?
Backtested data is from 2012. So 2012 till 2024, roughly 12 to 13 years of data we have.
Okay. Okay, Sahil says, sir, I'm happy and still attend the webinar. That's Vivek to you. So there are investors who are still attending. But yeah, you know
Yeah.
that happens if someone's not too happy, that's when they are more prone to come and ask questions that, hey, what is happening?
Yeah, it's fair.
Yeah. Okay. Divakar says, even after a month since the strategy change, Gulaq's performance hasn't improved. The market is doing well and other related small cases are performing. What could be the reason for this? By the way, I appreciate how Gear 6 is managed, the strategies, the transparency, and the team as a whole. I'm confident it will bounce back soon.
Yeah.
Okay.
So
That's
this is from Divakar, you said?
yes.
Okay, thank you. Thanks a lot, Divakar. I think I'll again go back to that slide, the data that I showed, that 1 month is very small time to judge any strategy. We have been heavily invested, our whole team, our company, right from CEO to everyone in the team has invested in this strategy. We believe in it. Obviously, we are biased also because we work in this firm. We are the ones who have created this strategy. But 1 month is a very small time really to judge any strategy.
Yeah.
That's what I have to say. Yeah.
Yeah. In fact, Vivek, you said we are biased, but a lot of people, they look at uh, the company's investment. So, skin in the game, how much the manager has invested. If the manager has invested in his or her own strategy, people feel more confident that, they are putting their money into the strategy. So,
Yeah,
they
definitely. See, all of us, we have been telling, I think people, almost every webinar only, we tell that all of us are heavily invested in this.
Yeah, yeah, yeah. I think like Divakar said, he still is confident that it will bounce back, but he's still questioning. So he's probably someone who's been following us since long, and that's why he's saying this. Because in the last webinar also this had come up that, I had realized that, hey, I am an investor. I am also seeing negative returns or flat returns, but I'm still continuing because I know the team, I know how everything is done here, and I have confidence. So someone who's more close to the manager, close to the team, they know better, and that's why we can have that confidence. So maybe Divakar is also following us since long. But of course, people who are new would have a little bit of a skepticism around it.
Yeah,
That's what we are trying to cater to here in the webinar.
right.
Yeah. Okay. Prakash is saying, I've been listening to your past webinars. Vivek sir patiently answering everyone's questions. Very nice.
Thank you.
Well,
Thanks a lot.
great, great. Abhilash says, I started investing 2 months back and currently my portfolio is 10% down. What should be the strategy now in this period?
Yeah. So Abhilash, I hope you haven't looked at short-term returns when you started investing. The strategy is fairly simple. Whatever I'm suggesting right now, it's not only valid for us, our funds, but equity investing in general. The longer term view that you take will really help you a lot in terms of avoiding the noise in the market, in terms of even avoiding the kind of underperformance that we are seeing and that almost every active, not almost, but every active fund goes through. Uh, so take a longer term view and uh, make your decision making devoid of, try to remove these biases and noises in the market. If you can do that and invest regularly in a systematic way through SIP, it will yield the best results. So yeah, that's what I have to say.
I think Manurakhi has summed it up really well. He's saying, Abhilash, stay invested and don't worry. Okay, Pratyush says, how can we hedge our small case portfolio during a drawdown situation?
It's very hard. So obviously in small case, we cannot do we can't hedge. Typically options are used to hedge these portfolios, right? And we also run a PMS. So in that PMS, we can actually hedge those strategies. Now, and even mutual funds, there are mutual funds who hedge. Now, in our view, taking a hedge is like timing the market, right? Or moving to cash, right? And that's a very, very hard thing to do. It's very hard to add, excuse me, value over long run if you do it. We have done a lot of research on this, how effectively to hedge or how effectively to move to cash. But in our view, it is a very hard thing to do. Very few people are able to do it. And it's very hard to add meaningful value over long run by doing hedging. And that's why we don't do it. Having said that, what we really want is, when we say we want to hedge, we want to reduce the risk in our portfolio, right? And the way we have designed our portfolio is in such a way, when I was just some time back explaining how we select these factors, right? So every month, the weightages to these factors keep on getting changed, dependent on the market regime. So what typically happens is, in good market conditions, the factors like momentum, growth, they get much more allocation. And the stocks which are mostly in the mid and small cap category, which are rising very fast. Those are the stocks which are not really, you can't tell them they are safer stocks. They are very aggressive bets. So we are increasing the risk in our portfolio during good times. Whereas in bad times, what happens is the factors like quality, value, low vol, these are the factors that get more weightage. So indirectly, what happens is you end up selecting more safer stocks, defensives in large caps. So that risk on and risk off is automatically happening in our portfolios to an extent. We are not purely moving to cash, but we definitely move to safer stocks during bad times. And this is happening automatically. So we are definitely reducing the risk in bad times and increasing the risk in good times. But it's not happening by hedging or by moving to cash. But but in a way that is happening in our portfolios.
Right. Okay. Narendra says, where do we see the total capital of year six? How much invested altogether? I think he's asking about the total AUM, AUA, assets under advisory.
It would be closer to, I think, 500 crores.
I think the last we checked, it was almost nearing 500 crores AUM. So
Yeah, that's
that's
what
the
it is. I think we are pretty far from the from place where it will start impacting the returns.
hmm,
Uh, yeah, so we are nowhere close to that currently. Yeah.
got it. Okay. Regan Fernandez says, what is the best time horizon to stay invested in year six in a way to achieve the maximum benefit?
So if you want maximum benefits, the time horizon is maximum that you can stay invested. So as long as you can stay invested, there's no ideal time. I would say in equity, take at least 3 year view.
Oh, okay. Three
At
year.
least 3 year view is what I would say
Hmm.
investors to take. And the longer it is, the better it is.
Hmm.
So an interesting thing happened. I was just in Mumbai last weekend, and we were talking to a few of our Gulaq and PMS investors.
Mhm.
And I met an investor. He was close to 75 years of age,
Okay.
and he's a client. And the way he was explaining about long-term investing, even at that age, he was very bullish about India, about investing, and and he was actually very much a longer-term investor. He still was taking a very long-term view. It was amazing to see him the way he was going about his investing. So he has been investing, he said, for a few decades now. So yeah, the longer it is, the better. If you can take that long-term approach, if you can think in terms of decades, really, instead of 3 year, if you can think in terms of decades, I think it will give you a huge edge overall as compared to the other investors.
Okay. Abhishek says, sir, कितना पोर्टफोलियो में गिरावट होने पे टॉप अप करना चाहिए?
Abhishek, you said, right?
Yes, Vivek. Abhishek.
So Abhishek, I don't think uh, you should do top ups when market falls. That's not a very good strategy. I have seen, so one of the advisor we were talking to somewhere around beginning of last year or prior to that, he said ki, I am not advising my clients. I'm not advising my clients right now. I would want, the markets are very high. I would want markets to drop by 10%. And then I have suggested my investors to get in. And the market actually from that point of time increased more than I think 40% or so. Our portfolio increased by 60-70%. And in that time, we didn't see that 10% drop that he was waiting for. And it came too late. So you understand, if you keep waiting for correction, that might never happen. So this is not a very good strategy. A better strategy would be uh, dependent on time. So whatever money you have, make it, if you have some lump sum. So if the savings on the investments are happening based on, say, your monthly salary, then keep putting in every month. But if you have lump sum, a better strategy rather than waiting for the correction would be you divide it into 3 or 6 equal parts and put it over the next 3 or 6 months. And if that meaningful correction were to come, you can actually invest everything together. But don't wait for that correction because it might actually never happen, or it might happen after markets rise by say 20% or 30%,
Hmm.
right?
Makes sense. Okay, so Vivek, there are a lot of your fans in the chat box. There is Sachi says, I too appreciate the way Vivek sir takes the questions. His demeanor gives a lot of confidence that money is in good hands. That's that's great to know, and thank you so much, Sachi. Even Roberto says that he likes the way you talk, very calm and patiently. And any secret of having this amazing speaking quality? So,
No, I am by nature, I'm mostly uh, I yeah, no, nothing to say about that.
I think
But thank
honesty is
you for
what
these
we,
good comments.
yeah, I think honesty and transparency is what we go for. And if
Yeah, I
we're
think
able to,
that's with the firm. It's not only my quality, but I think the environment we all are in,
yeah,
that's what yeah, we try to do.
yeah. Okay, Akash is asking if we can recommend some sources, books, courses, etc., for learning about financial management for a beginner.
So, yeah, this is something that maybe I'll need some time to think, but one of the book our CEO has written, and I've had the privilege of contributing a bit to that book. So Sandeep Tyagi, our CEO, he just, I think last month or last to last month, this book was launched, The Little Book of Big Gains, and it's available on Amazon also. You can check that out. We have tried to write everything about the way investing, at least our way of investing, the way we believe investing should be done. So that is one book you can check out.
Yeah. And I think the our
Yeah,
interview, so I've also taken an interview of Sandeep in our office. So that interview is also now
on YouTube.
already live on our
Yeah.
YouTube channel. So please do have a look, and he's sharing his life experiences, what made him write the book, how he sold a company for crores of rupees and also lost 50% of that wealth in the global financial crisis. So it's a very interesting interview. Do have a look at that. And just to add, I think you're talking about courses. I'll also be launching a course of mine in a few months on financial management. So people can look at that. I'll start an Insta page by, I think, Finance with Eesha. I'm not sure what I'll do there, but I'll start a course if someone wants to look at financial management for beginners. Then another question, Vivek, is that Manorakhi says, I'm equity investor through mutual funds, PMS, since 2017, and I have never redeemed. Debt funds I used for redemption have seen 2020 fall too. Okay, I think he's just stating the
Okay.
comment. Then Akash is asking for PDF of that book, of Sandeep's book. Do we have any PDFs or Kindle
So
edition, let's say?
we don't have a PDF, but pretty soon what we will be doing is Sandeep is now in India.
Hmm.
What we'll do is our plan is to record these videos so that people can watch. So we'll record these videos and put it on YouTube for everyone to see. That is something, it might take maybe a couple of weeks time, but that is something that we'll definitely do. So yeah.
Okay. Um, I did see a few more questions. Just a minute. Okay, there's a comment from Vivek Sharma. I'm planning to stay invested for minimum 10 years.
Great.
Okay. Then there was a question on certain returns that I'm trying to look for. Total capital. Okay. One question from Tushar is, I invested in Gear 6 on in October 2022. I have gained only 5.12%. Why? That's quite less. That's not seeming correct, right, Vivek? Tushar
Yeah,
Katari.
it doesn't seem correct to me, definitely.
Hmm.
Uh, Tushar, you should definitely write to us. I think this should not be the case. Only case that I can think of is, let's say you started with 25,000 in October 22,
Hmm.
and say about 2, 3, 4 months back, you invested 1, 2 lakhs, much more than what you started with. So your XIRR would be something like that only, maybe 4, 5%. So that's the only case that this could happen. Otherwise, I really can't think of any other case, even with these slippages and brokerages, it can't really be this low. So
Yeah.
if that is the case, it can happen, but otherwise it should not happen. So I definitely would want to see what has happened. So please do write to us. I would definitely take a look and revert exactly what has happened in this case.
Then, yeah, Sachi says possible to share 5-year rolling returns of the backtest of current strategy and how it compares with the benchmark.
Okay, this is something definitely we can share. I'm just thinking aloud, Isha, how should we share this? So we should share maybe, okay, what we can do is we can write a blog uh, about all these backtesting details of
Yeah.
the current strategy. Obviously, we have shared this earlier of the older strategy,
Hmm.
but now that we have this new strategy, we can write a blog with all the details uh, about all of these details, be it
Definitely.
five-year rolling returns and other parameters.
Right. We
So
can
please do,
write a
yeah.
yeah, we can write a blog and we can send out an email to all our
Yeah,
investors,
that we anyways do.
even in
So
the
maybe give us some time, a week or two. We'll definitely come out with this blog of backtesting.
yeah. And we'll also update it maybe Vivek on the small case section, managers update section.
Yeah,
And of course, by the next month's AMA webinar, we can share
definitely.
the list of all the new blogs and all the info
Yeah.
class for other parameters as well. So happy to include all of that in the blog. Then okay, Narendra says, does Gulaq Gear 6 have any WhatsApp contact, please? He stays out of India.
Okay.
Yeah, Narendra, the same number which we have shared as our customer care support number, it is also reachable via WhatsApp. So you can drop a WhatsApp message or even call the number on WhatsApp and you will be able to get the response. What I'll do is after the end of this webinar, I will quickly put the WhatsApp number in the chat box here, as well as the email ID of our support team. So feel free to reach out to them. Most welcome. All right, I'll just scroll to the top, Vivek, to see if there are any questions that we missed out. Yeah, I think we're all covered. No new questions. Uh, okay, performance of Gulaq versus PMS. Prakash has just asked.
Okay, Prakash, what I would suggest is if you go to gulaq.com, there's a section, PMS section. So you can go there, look at our PMS strategy. And if you want to contact, you can either contact on the Gulaq support or just leave your details on that PMS page and we'll be happy to call you back.
Perfect. Narendra is asking if there are any courses which can help you learn about fundamental and technical analysis.
So one of the course I can suggest is, which will be coming out in next few months, Eesha will be launching. I don't know of any other course. Yeah.
Yeah. That will be on financial literacy, financial management. Thanks, Vivek.
Course, I don't know really. Yeah, I don't really know. See, most of these courses, there might be few good ones, but most of these courses are from influencers or content creators. They're not really from market practitioners. So somebody who has been investing in markets for 10, 20, 30 years, uh, I don't see courses. If there is a course of somebody who is actually a market practitioner, I think that would be really a good course, but I don't know of any other course, any such course. Most of these courses are uh, somebody who has been investing for 1, 2, 3 years. Most of them have come out only after COVID. They just started investing and launched these courses. That's what I know. Yeah. So yeah, I wouldn't really recommend any course, at least not any really good one that I know of.
Okay. Okay, couple more questions just came in. Pratyush says, if a certain stock deviates from the criteria you choose for the small case, will you wait for another month's update to remove it, or would you make a change between the updates?
No, so we really don't make any change during the month. We have tried this systematically, so this happens only month to month, not during the month. We have tried this out in our back tests. It hasn't really given us good returns, which is actually rebalancing as and when needed. So in our view, that's not a better strategy. The current one is the one that we are following. And also regarding if some big news come out, would we take any human intervention? Would we do any human intervention? I don't really think we would, because we are not good at it, really. What we are good at is creating these quant strategies and then let them decide what is the best approach. Obviously, we'll follow how it is performing, follow all the risk metrics on a day-to-day basis, but not really intervene. That is not our core skill set, right? So, yeah.
Okay, Amit has asked a question which is similar. Kamit, we've already answered this in quite some depth about, the strategy and how it's been performing lately and why we have made all the changes that we have. So please rewind the YouTube live session. It is recorded and it's there available on YouTube, and you will be able to understand the rationale. And I think Vivek, that with that, I think that was the last question. Thank you so much for joining. Any last comments that you want to share?
Nothing. I have been speaking a lot. Maybe you can share. I have been speaking a lot.
Yeah, I know. I think that's whatever you've shared. Just to summarize, you should stay invested for the long term. That is the key, because a lot of people are currently worried about the returns in the market. So staying invested for the long
I
term
think
is
stay invested, and sorry, but one thing is, definitely do attend these webinars. And if you have any issues, concerns, please
right.
do let us know so that we can address it.
Hmm.
So yeah, that's the only thing I would say.
Definitely, definitely. And we are here, as you see, we try to cater to each and every question that comes up. So we are here. We even continue the webinar for 2 hours at times if the number of questions are those many. So feel free to ask as many questions, and do join these sessions if you want, if you have any questions. We are always there to help you and answer. All right. Thank you so much, Vivek. Thanks
Thank you.
everyone for
Thank you,
joining.
everyone. Thanks a
Good
lot.
day. Bye-bye.